Markets hate uncertainty.
Yep.
And there's a significant amount of uncertainty coming down the pipe through current government legislation in the US, whether it be tariffs, whether it be Doge, whether it be some of the decisions that relate to conflicts in the world and everything else in between. So, you've got a situation where all of this stuff is almost happened at once. And I think maybe on reflection, the administration would have been better served to go, right, major priority, first of all, is illegal immigration, which is largely under control now. And Holman's doing a pretty reasonable job of enforcing that policy. Now that's ticked, let's move to another spoke in the wheel. And if that happens to be Doge, so be it. And we're going to spend the next 3 months focused on that. And once that's done, we'll move on to the next thing. And once that's done, we'll move on to the next thing and gradually go through the various things. And during that time, markets have got the ability to absorb the volume of news and uncertainty that's coming down the pipe, which provides a platform of stability. That hasn't happened. And I think that's largely a reason why we've seen the sell-off and the movement toward other assets. Hey guys, welcome to this week's Money and Investing Show. This week we are looking at crash or correction. Markets have gone through a fairly tough time at the start of this year. What does it mean for you? What does it mean for your money? And more importantly, where is this going from here? Plenty to take out of this. Most importantly though, don't just simply take notes. Make sure you take plenty of action. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Olarenshaw.
Good to be here, Mr. B. Now, rather somber mood out there for markets, I believe, at the moment. We've seen a lot go on over the past few weeks, but I hope that these definitions in this context we can provide, along with the strategies for investors, crash or correction, what it all means, will help them.
Indeed. Look, I'm sure the sanctuary and safety of the padded walls of our podcast studio is probably a little safer than the rough and tumble of the trading desk. It's been a brutal start to the year, I think would be the term. I think it probably had arguably one of the worst quarters in decades, I would think, for the indices. That's
right. Last 6 weeks in particular too, 5 of which have been losses, which hasn't happened for a long time. I think since COVID, we've had that kind of sell-off. So it's been pretty hard and fast. It's been vicious out there. So a lot of people have felt some pain.
For sure. And I mean, if you look at the bigger picture, markets have put on a couple 100% over the last 5-6 years. Giving some of that back is to be expected. Not fun if you're someone that's brand new to this and you've just started at the ding-dong high in the market and you're seeing this fall away. And I think, understand the difference between a crash and a correction. These things are expected. They are cyclical. They happen during every cycle, every decade. You can expect to have a decent pullback, whether that be a crash or a correction. So I guess a good place to start is defining the difference between a crash and a correction. So right. What do you got for us from a stats perspective?
Well, let me jump in. So correction is 10% down from recent highs.
Which is a tick.
Okay, which is a tick. So the S&P 500 at the moment is just above that correction territory. It's down about 11% from its record highs, not wishing to date this podcast. The NASDAQ, a little bit more than that, probably heading more towards crash territory. It's down about 15% from its record highs.
And a 20% would be the sort of definition for a crash.
/ a bear market.
Or bear market. So a bear market, for those that are new to this, is where a bull market is where prices are moving higher, bottom left, top right. A bear market is where you're in a more sustained trend of top left to bottom right. It's a downtrend, effectively.
You'd only just found out why it's called that. And I've worked nearly a decade in markets, and I only just figured out the whole analogy behind that.
All right. So for the benefit of everyone, so New Amsterdam, which is what New York now is, down at the bottom end of the Manhattan Island, as it is now, was a wall, which is where Wall Street is, and there was a pit there, and they used to fight bears against bulls for entertainment. And bears always attack going down with their claws, and bulls go up with their horns.
There you go.
Bull market's going up.
That's right.
Bear market. Did you only just find that out?
Yeah. I'm a trader, not a historian.
How did you slink through your interview process with us and not know that? We've got a massive bull, there's bull statue and pictures everywhere.
I got told you hire on character, not on memory, so I just passed the test.
Touche. I'll take that one on the chin. Nice work. So let's get back. You're on fire today. Well done.
Thank you.
You're getting a bit of sleep.
Yeah.
So let's get into it. So a crash, 20%. Now, typically when you think about crashes, you think about the 87 crash, which was the one that caught me when I'd first started in markets. I bought my first shares just before that. About a month before that. So I know what it can feel joining, and it was everything I had then. I think it's a couple £100. And then the October Black Monday happened and down the market dropped. But the thing typically in my mind when I think about crashes rather than corrections is the velocity that they happen. And a crash typically can be a couple of days. So there's a bit of a build-up, market started to roll over, and then boom, really, really substantial down days. I'm not talking about 4%. I'm talking really, really substantial down days, a couple of days in a row, a little bounce in the middle and then another one. And that's your 20, 30% done. Think about the tech wreck. The NASDAQ went through quite a strong rolling top, actually, where there were a series of lower highs and then bang, it went down.
Yeah.
If you think about the GFC, the markets broke that uptrend that they'd been in through to 7, 8, and there were a number of lower highs, and then whammo, down she went after that. So I think for me, in my mind, based on my experience in history, a crash has always got a lot more velocity to it. Either way, the outcome's the same. What you had that you paid X for is now worth Y, which is significantly less. The other side of the coin to that, of course, is if you're sitting in a level of cash right now, this is a wonderful buying opportunity because you have the ability to buy into stocks at a 10 or 15% discount to where they were trading, a handful of weeks ago.
Yeah, and I think it'd be worth us doing a psychology episode too, pertinent around these conditions, AB, which we might do maybe next week. But like I look at myself personally, I think sometimes you've got to get the bad out. So when that sells,
that's a nice nudge to keep me on track, by the way. You're really on fire today.
Oh yeah, I personally, for example, when the market sold off, I think when we just after correction territory initially took some fairly long geared positions in assets like TQQQ and gear on the Aussie market, which have been quite good to me thus far. So buy the bad news rather than run away from it type thing.
I think you have to, and that requires, as you say, a level of psychology. We'll get into that, I'm sure. And the interesting thing also is the differential between the NASDAQ and the S&P. So the S&P is, let's call it more traditionally older school type businesses, your traditional economy. NASDAQ tends to be a little more tech focused. And I guess, out of that, stocks like Tesla, who have, I guess, fallen from grace on many metrics, and it's probably worth exploring the contribution that stocks like that actually do make to the NASDAQ, because they were part of the run up, and obviously given the pummeling that they're getting right now is going to be party to why the index is coming off in the way it is. And you've got slower sales, and I think if you try and look objectively, which we always try to do, EV sales were slowing down anyway. And there'll be a different narrative that goes alongside that, because of Elon Musk's association with the Trump administration, there's been a backlash, which there has most certainly been. And you've seen the sort of protests and the vandalizing and the criminal acts, which is disgraceful. The irony is all the people that are protesting are the people that were previously Tesla buyers as well. So it's kind of, I guess it's the Bud Light moment for Tesla insofar as you've done something to really disenfranchise your more loyal clients, if you will. But slower EV sales, and then this political backlash towards Musk has been responsible for a real dry up in sales, and that's weighed heavily on the market. But then the NASDAQ's been the biggest game in town too. You've got companies that didn't exist a few years ago, which are the biggest companies in the world now. That's
right. And those magnificent 7 stocks like Tesla, Apple, Google, Microsoft, Nvidia, it's about 30% of the index they make up by market cap. Yep. So they're a big component. I think though, AB, the thing on everyone's mind right now is why we've seen such volatility. And the thing that springs to my mind is Mr. Donald Trump in regards to some of his policy decisions.
Yep.
Let's explore that now.
Look, the 47th president, there's no question about it, has been an interesting start to the journey for President Trump's second term.
It's a very generous way to put it.
Yeah. The reality, I think, is that you've got a lot of things going on at once. And I was just chatting with one of the team earlier, just when we're getting a coffee, about all of that. And I think, had the administration taken an approach, well, let's preface this with one simple thing. Markets hate uncertainty.
Yep.
And there's a significant amount of uncertainty coming down the pipe through current government legislation in the US, whether it be tariffs, whether it be Doge, whether it be some of the decisions that relate to conflicts in the world and everything else in between. So, you've got a situation where all of this stuff is almost happened at once. And I think maybe on reflection, the administration would have been better served to go, right, major priority, first of all, is illegal immigration, which is largely under control now. And, Holman's doing a pretty reasonable job of enforcing that policy. Now that's ticked, let's move to another spoke in the wheel. And if that happens to be Doge, so be it. And we're going to spend the next 3 months focused on that. And once that's done, we'll move on to the next thing. And once that's done, we'll move on to the next thing and gradually go through the various things. And during that time, markets have got the ability to absorb the volume of news and uncertainty that's coming down the pipe, which provides a platform of stability. That hasn't happened, and I think that's largely a reason why we've seen the sell-off and the movement toward other assets. The big one, of course, is tariffs, and this has been coming down the pipe, and Liberation Day is now behind us, and we've heard the extent of what's happening to whom, and markets can start to get a handle on that now. The damage isn't totally done, though. The announcement of these are going to be the tariffs are one thing, but it's what the economic implications are is what markets are really trying to get their head around now, because you buy a stock today for what it's going to do in the future, and what it's going to do in the future is very much going to be impacted by the latent effect of what those tariffs look like. And we can certainly explore some examples of that.
Probably two things that spring to my mind to attach to that. Number one would be potential inflation that comes as a result, but also lower growth forecasts as well for companies. So if we, for example, start with inflation, if you are paying more for the same good, or you're forced to purchase an American good, which is now more expensive by virtue of less competition, that can be inflationary for the consumer.
That's exactly right. And, we've seen the central bank in the US do quite a reasonable job of both communicating, and we've been quite vocal about that in ourselves, the job that Powell's done, keeping markets across, what's been happening. But also the way that they've been on top of it policy-wise. They got to the party at the right time, and they've acted quite responsibly. The challenge is that if you see the embers of inflation start to reemerge, and as a sidebar, I suspect, we've seen the RBA pause on rates at their most recent meeting, again, without wishing to date this podcast. And the reason for that is the trend of inflation hasn't changed. There's been a cut, but then you've also got an election in Australia with massive government spending going on. I thought the sneakiest thing was giving people $150 off of their electricity bill, and it should be means tested in the first instance. The reason they've given it to everybody and not means tested it is because it's going to come off the inflation figure, so it looks like inflation is trending down. The RBA picked this, and anyone with half a brain should pick that it's just purely political window dressing on the part of the Albanese government. And so the RBA have picked it. They haven't cut rates. So they've been quite smart in that regard. But the point I'm making is that inflation is one of those things that it can look like the embers have gone out, rather like a fire, but you put your hand in it, you realize it's still pretty hot in the middle there. And it doesn't take a lot to really rekindle that. I think the notion of tariffs increasing prices is very real. I think the expectation from the White House, in my mind, and obviously I'm not in the White House and it's a fast-moving beast as it stands, is that you'd also want to see lower energy prices on the other side of the coin, starting to combat the growing embers of inflation. And so net, you've got that kind of drop coming down. But if energy prices don't come down quickly enough, then that will likely see inflationary pressure in the US, which then ceases the current rate cutting cycle, probably pushes bond yields higher, and really changes the game. And at the risk of having higher interest rates, if the Fed have to put rates back up, it slows down business investment because people are less confident borrowing, slows down economic growth because people are sitting on cash because they're uncertain of things, slows down the property market because access to finance has changed. So there are a whole series of negatives that could potentially come from that.
Yeah. I'll give you two stats to confirm what you're saying. So if we look back in 2018, during his first presidential term, he introduced a 50% tariff on washing machines.
Washing machine tariff, yeah. These numbers are crazy.
Yeah. Now that costs the American people an extra $1.5 billion annually now for washing machines.
Wow.
In return, we got 1,800 jobs out of it. So not a great trade-off, you could argue. With these current tariffs, economists now are expecting that the average American household will have around $3,500 less in their annual household budget. It may not seem like a lot, but don't forget there's a huge discrepancy in wealth in the US, and there's a lot of households. So on an aggregate basis, that's a big number.
Oh, without question it is. Anything that sees households worse off is not a great thing at a grassroots level within an economy. And again, the other side of the coin that must go alongside this for that policy to work is strong jobs growth. Strong productivity increases, which then enable people to earn more to more than offset that. But there are an awful lot of moving parts in that machine to get that outcome. You look on the other side of the coin, if you look at, say, Westinghouse or GE with their manufacturing, how much more of a market share did they get on the back of it? How's their share price performed on the back of those tariffs on washing machines? There's another side to that argument too. But the bottom line is that it does run the risk of potentially being inflationary. The other challenge, I think, also with uncertainty, and I think this may potentially reflect in the way that the markets have responded, are companies that have got decent supply chains. So if you're a company that manufactures, and we saw this through COVID, and also of course the Suez Canal debacle, which we saw that freighter run into the side of the wall in the Suez Canal and block it up and disrupt world supply chains for a while. Is that what is the impact on the supply chain of tariffs, where companies go, look, it's harder for us to get that part from that country now. We've got to get it from somewhere else in order to do it. What does that do to our supply chain, which then slows down output, which slows down sales, which slows down sales revenue, which slows down the share price? So, there's a series of factors that are still being sort of ruminated by markets on that. And here in Australia, I mean, I've got an interest in cattle very much so. I've got very dear friends that are in the cattle industry, and the idea of a beef export tariff to the US is really punitive for our farmers. The question you've got to ask yourself is what's that government doing from a lobbying point of view to go, hey, we're in the tent, we're your defense partner over here, you've got a couple of bases, including a listening and satellite surveillance system over here in Australia. We're with you on this, so how about you cut us a break? But unfortunately, we've got an ambassador that refers to the president as a village idiot, so it's not surprising that we've been on the wrong end of those tariffs. And by articulating your position, the issue for Australia not importing US beef isn't protectionism necessarily, because if you couched it in a very different way and said, look, we'd love to import your beef, however, in your manufacturing process you use, let's say, a particular antibiotic or a steroid, both of which would be used in American beef production. We don't have them in our food chain here in Australia. If you're able to remedy that, we'll import your beef.
It was the mad cow disease, right, which caused the initial right.
Yeah. So that all of these sorts of things, have ramifications. But if you're inside the tent and you're able to argue your corner, you can potentially avoid incurring the wrath of President 47, which is not where you want to be.
Yeah, I think that sectorial response will be quite interesting. Like at the moment, we've just had Liberation Day, so the whole market's sold off as a result.
Yeah.
You're seeing stocks, for example, like Nike and Apple, who have supply chains throughout Asia quite a lot. Nike in Vietnam, for example, they've probably been hit the worst, whereas financial institutions have actually gone higher, which is quite unusual.
This the other day. I mean, if you wanted to have a fairly there's a few podcasts ago, they've all blurred into one this year. It's been a whirlwind start
to the week for 5 years now. It's
pretty good.
It's pretty good effort. Well done.
Sure. And the if you wanted to have a defensive exposure to the US economy that wasn't exposed to the globalism that most manufacturing companies are, then it would be the American banks. And we talked about that very clearly a few weeks ago. And so good to see that they've held up.
Totally. Let's talk now a little bit about more about some economic indicators to watch, AB. So crash or correction, we've gone through geopolitics, tariffs. What about American or Australian economic indicators? I mean, the few that spring to my mind, which we've mentioned briefly, bond yields, employment, consumer spending, these are all big ticket items.
They are. And the world of macroeconomic indicators, how to put your classroom asleep in 30 seconds, if I remember from my time at university. But there are some important things here. Normally, if you're someone that sort of, you've got an interest in investing, this is the granular stuff that you leave oftentimes to the experts, or it's in the background, it's subliminal. The big one I'd be watching is PPI, which is the producer price index in the US, because if the tariffs are inflationary, as we've just talked about, PPI you're going to see is going to jump up fairly quickly. And there's always a lag. We've talked about this previously too. I guess after 5 years, we've spoken about a lot of things.
A lot of stuff, yeah.
PPI is the cost of producing stuff, and it's measured by the PPI index in the US. So if you see that jump up, the CPI, which is the inflation figure that most people are aware of, when they look around, there's a lag. So if you see PPI jump up, 4 to 6 weeks later, maybe slightly longer, you start to see CPI then move up as well. Why? Well, stuff needs to get made, costs more to get made. Then it gets shipped and out to markets and then sold at a higher price to cover that cost. So look out for that PPI, because that'll be a leading indicator for CPI moving higher. And if you see CPI moving higher, you're very likely to see bond yields moving up. So you've got that PPI figure is crucial. And that's what the market will be looking at, not CPI, because it's more leading in terms of seeing the immediacy of the impact of these tariffs. So that's one to look for. Slower employment. So if you start to see unemployment or the job market flatten out or become a little bit soggy. And the wonderful thing the US has got going for it is a couple 100,000 people that were working for government that no longer are, that are now in the workforce looking for gainful employment. And so there is now a new supply of workforce coming into the market, which you've got to look at how that gets absorbed across the private sector. So looking at unemployment is also a big one. They'd be the key ones I'd be keeping my eye out for over in the US right now on the back of this for sure.
Yeah, it's funny. I've done a lot of research into these data points. I mean, I follow them every day, but there's a big difference between what we call hard data and soft data. Yeah. The hard data has actually been pretty good. Like we've got really low unemployment, which is great. That means you can't have a recession because you've got low unemployment for the most part. CPI has been okay. The personal consumption's expenditure, or PCE data, has been okay.
Yeah, that's people's spending, which is,
right,
I guess, a confidence indicator. It shows that people are happy to get the wallet out and go spend.
That's right. The soft data on the other side of the coin, things like the consumer inflation expectations come in at its highest level rather, in many, many years. Consumer confidence has also dropped to a couple of year lows. So that softish data, not so good, but the actual hard data is quite strong. I think if you're going to make a decision, you favour the hard data every day of the week.
I think you have to, because the soft data is an interpretation or an expectation, and I don't think it's forward-looking because it's a much more emotional response. So if you walked up to your average person in the street, Joe Bag of Donuts, right now today on the back of the tariffs being announced and where the economy is, or whatever it may be, and said, how confident are you in terms of maybe buying a new car over the next 3 months? I'm not confident at all, just because the news flow of that day has shaped the psychology of how you think, because people are exposed to so much news, good news, bad news, fake news, and everything in between. On the other side of the coin, the actual hard number of people spending is a fact. It's not an opinion, it's not a perspective, it's not a feeling, it's actual fact. And I always make decisions off facts.
Yeah, consumer spending has been pretty good, to be honest.
Yep.
Even in the back end of last year, we had record Black Friday and record Cyber Monday, which is a good indication that people are still willing to get the wallet out. I guess moving forward, which is the $1 million question, or arguably the $1 trillion question, is what's going to happen from here, right?
Okay, let me just get the crystal ball out and work through that. But I think now that the tariffs, which I think were probably one of the bigger anchor points that the US was pushing onto the rest of the world, that's out there now. And there's a period of time where that news will be absorbed, and there'll be the winners and losers. You mentioned sort of Nike and sporting apparel. I guess, Under Armour and a few other companies will be in that genre that are affected. Yep. And whether that's an overreaction or an appropriate reaction from their price, time will tell. So I think we're going to see maybe a couple more days of response to this. But markets actually respond pretty quickly these days. The news flow. I'm not going to say back in my day, but before my day, if you wanted to know what was going on, you'd read the newspaper. Financial Times, arguably one of the best publications in the world for objective news. But it's a day late. It's what happened yesterday.
Oh, that's so long ago.
But that's how most people would have got their news. Now we're on that real-time streaming. Okay, maybe the quality of the news has diminished too in terms of the accuracy of it too, but nonetheless it's real-time. So I think markets do tend to react more quickly because you've got a quicker, wider and more vigorous distribution of that information. And as a consequence, that flow of information is now out there. People know where they stand. There's going to be a day or two while the scales sort of balance back up again. And maybe that puts us in for a little bit of a baseline for the foreseeable until we start to see things like that PPE data and then CPI data coming in on the other side of it as a hard number that's in response to that.
Yeah.
So I think, we might see a little bit of a dust settle over the next few days. That will be and again, without wishing to date the podcast, we're talking as we see things today. Markets will digest that and maybe that puts a bit of a base in. And provided we continue to see earnings growth come out of these businesses and we continue to see, good employment data and people prepared to spend, I think this may well prove to be a good buying opportunity.
Yeah. Yep, and I think from here, just play it smart. I think having your psychology under control is paramount initially before you make any decision with regards to your money, which, as I say, we'll do a podcast on this as well. And then have some level of risk management. Whichever way it goes, whether it goes up or down, you want to make sure you're protected. Yeah,
I think that there's sound marker points for people to really focus on. And again, the media loves to pour hate on the current president. Because it's been shown through the previous presidential cycle, the massive left-wing bias that's in mainstream media.
Yep.
So everything you're seeing is an amplification. Okay, there are some things in there that are uncertain. There are some things that are causing volatility in markets. There's no question about all of that. The way it's being reported, however, is probably slightly left of centre, I think it would be fair to say, and portraying it as the worst thing that could ever happen. And all we're seeing here is a president that's been elected to focus on his own economy, not the world. It's not the US's responsibility to be the mantle of the world, and level the playing field a little bit so that the US has an ability to move forward. And all of these policies that we've seen, crazy as some of them, at least on the surface, seem to be, and most certainly have been reported. So the bottom line with all of this, these things are happening very, very early in the presidency. And you've got, basically 3.5 years until the next election, where these are so far in the rearview mirror that people have almost forgotten about those measures as the economy rebounds, finds its feet, and begins to move forward. And we're looking through the microscope, which we have to, because people look at their money on a regular basis, and if it's down 10 or 15% from where it was at the start of the year, it doesn't feel like the ideal set of circumstance. In 2, 3, 4, 5 years' time, what was that about again? If you had to do a decade in review, that's a very hard conversation to have with people, which is why psychology is such a critically important thing. And it also is very visceral when you're living through it in the moment. And I think it's more than anything highlights two things. Number one, you have to have time working for you and take a longer term view when it comes to making money. It takes time. There are cycles, there are movements within cycles, phases within there that can affect it. And then secondly, not only do you have to have time, but you can't get bounced around from headline to headline, because that'll drive you insane. You've just got to step back out of it and go, this will level and all things will be good again. Absolutely. AB, interesting to see where to from here. Thank you very much. Always a pleasure. Anytime, Mitch. There you have it, guys. Make sure you like, comment, subscribe. Most importantly, hit the notification button, and we'll look forward to hosting you next week.